G'day guys, Nathan here from Hunter Galloway, and welcome back as we deep dive into the Reserve Bank of Australia's recent decision to hold the cash rate at 4.1%. Stick around as we uncover the implications of this decision, how it's going to affect you, and what to expect in the uncertain economic landscape ahead. The Reserve Bank of Australia has kept the cash rate steady at 4.1%. They opted for a more cautious approach in their assessment of the current economic conditions and forecasts, even though there was an anticipation for an increase, as well as another one in August, which would potentially push the cash rate to a peak of 4.6. The Reserve Bank of Australia decided otherwise. With the cash rate on hold in April and successive rate increases in May and June, there is still a prospect that the cash rate will peak at 4.6. The RBA's decision to maintain the cash rate is based on various factors that require closer examination. An adjustment to the monetary policy might be necessary to bring inflation back on track, depending on how the economy goes and inflation as well. By keeping the cash rate stable this month, the Reserve Bank has a bit more time to observe the economic state, its potential fluctuations in the future, and any risks that are associated. If you do find value in this video, please consider hitting that subscribe button, as it does really help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. The board will continue to monitor global developments, trends in household spending, and forecasts for inflation and the labour market. It's committed to its objective of bringing inflation back within its target and will take necessary actions to fulfill that goal. In its statement, the Reserve Bank pointed out consumer sectors continued with uncertainty. The blend of increased interest rates and the cost of living significantly slowed household spending. While some households enjoyed rises in house prices and sustained savings, others are facing a severe financial strain. Interestingly, the Reserve Bank of Australia's statement lacked any reference to the potential rise in inflation that it mentioned in June. This missing element leads to a slightly less cautious tone in the statement. And ANZ is forecasting that the Reserve Bank is expected to raise rates in August, with a subsequent increase maybe in September, October. However, if labour market conditions start to soften, it might make rate hikes more probable to happen later in the year. Interest rates have seen an increase of 4% since May last year, and this rise has actively assisted in creating more sustainable balance between supply and demand in the economy. The balancing effect is anticipated to continue. There are households with ample savings reserves, while others are facing severe financial strain. Interestingly, there are signs that consumers are beginning to display caution, and this sentiment seems to be seeping into the labour market. Historically, a dip in consumer spending usually starts to impact the job market after a few quarters. Signs are now starting to emerge that the previously tight labour market conditions are starting to relax. One possibility is that businesses may be hesitating to let go of their workforce, given the past challenges in attracting and retaining staff. In the event sales start dropping, businesses may prefer to reduce existing work hours rather than laying them off. However, if businesses continue experiencing weak sales, there may be increased pressures on cutting costs, which may result in workforces being downsized. Consequently, unemployment rates might rise and businesses will face less pressure on increasing wage costs. Concerns arise when individuals start losing their jobs and live in fear of unemployment. Such situations tend to result in people significantly cutting back on their spending. This consideration explains the decision for the Reserve Bank of Australia to maintain the stable cash rate while monitoring how the labour market and wage growth react to the ongoing slowdown in consumer spending. Even as the RBA approaches the end of its tightening cycle, it recognises that monetary policy tools may still be required and will play a role. The rising rental costs and electricity prices continue to apply pressure on inflation, yet the persistent issue of sluggish productivity growth remains a significant concern. Remember to like, share and subscribe to stay informed with all things property and finance. Wage growth, according to the RBA, is still within the inflation target, provided productivity improves. The implication, however, is that if there's no boost in productivity growth, the pace of wage growth might be too swift to bring inflation back into the Reserve Bank's target range of 2 to 3%. Now, I want to share some of my thoughts on the current economic situation. Firstly, it's important to note that the Reserve Bank has maintained a conservative approach by opting to hold the cash rate steady at 4.1%. This is likely a response to the blend of heightened living costs and increased interest rates that are slowing down household spending. The central bank isn't blind to the growing financial stress faced by many households, and that's why they've chosen to hold the cash rate this month, which will give the economy a bit more time to adjust and rebalance. While the market had anticipated an increase in the cash rate, the delay shouldn't be a sign of panic, but rather a reflection of the bank's commitment to closely observe the economic landscape, manage risks, and ensure inflation doesn't get out of hand. It's essential the Reserve Bank of Australia plays a long game here. Looking forward, even as there is expectations that the cash rate will peak at 4.6, the path to getting there has become a little less clear due to the recent pause in the cash rate. We're seeing early signs that consumer caution is starting to impact the job market. A dip in consumer spending usually sees an impact on employment. And while businesses may opt to reduce work hours rather than cut jobs, prolonged weak sales might force them to make significant workforce downsizes. For prospective homeowners, it's a good idea to keep an eye on these factors. The rise in interest rates, for instance, is a significant determination in loan affordability. On one hand, the cooling labour market might provide the Reserve Bank of Australia a reason to pause the cash rate rises in the future. The fact that interest rates have gone up 4% since May is a clear sign that we're moving in the right direction and we're hopefully close to the peak period. Also, households have been able to accumulate substantial savings during the pandemic, and these reserves could be instrumental in maintaining economic stability as we navigate through these challenging times. The Reserve Bank of Australia is demonstrating its strategic approach to managing the situation, their commitment to bringing inflation back within the target range while also maintaining an eye on household spending and labour markets is reassuring. For prospective homeowners, I'd advise to closely monitor the situation and seek advice from a professional who understands the current state of affairs and can help you understand how these might impact your circumstances. As always, we at Hunter Galloway are here to help, so please don't hesitate to reach out if we can be of any assistance. You can contact us directly by calling 1300 088 065 or visit our website huntergalloway.com.au. Guys, thanks for watching and we'll see you next time.